How do central bank policies use GDP forecasts? Imagine trying to steer a ship without knowing where the shore is. Central banks face a similar challenge when they decide how to manage the economy. They relying heavily on forecasts of gross domestic product, or GDP, to guide their decisions. GDP measures the total value of all goods and services produced in a country over a specific period. It acts like a health report for the economy, showing whether it is growing, slowing down, or shrinking. Central banks create these GDP forecasts by analyzing a wide range of data. They look at recent economic activity, employment levels, inflation trends, government spending, and even global economic conditions. Economists at central banks use different models and expert judgment to predict how much the economy will grow in the coming months or years. These forecasts are updated regularly as new information becomes available, helping policymakers stay on top of changing conditions. Once they have a forecast, central banks use it to decide how to set their interest rates and other monetary tools. If the forecast shows strong growth that might push prices higher, the central bank may raise interest rates. Higher rates can slow down borrowing and spending, helping to keep inflation in check. On the other hand, if the forecast indicates the economy might slow down or enter a recession, the central bank might lower interest rates. Lower rates make borrowing cheaper, encouraging businesses and consumers to spend and invest more. The process of forecasting GDP is complex. It involves multiple models and assumptions about future policies and global trends. Central banks do not rely on just one forecast but consider a range of possible outcomes. They often include confidence intervals, which show the likelihood of different scenarios. These help policymakers understand the risks and decide whether to adopt a cautious or more aggressive approach. GDP forecasts also help central banks communicate their plans to the public and financial markets. Clear communication about expected economic trends can influence market behavior and set expectations. If a central bank signals that growth is slowing, markets might prepare for easier monetary policy. Conversely, if they forecast rapid growth, markets might brace for tighter policies. In summary, central banks use GDP forecasts as a vital tool to anticipate economic conditions. These forecasts help them decide when to raise or lower interest rates, how to manage inflation, and how to support employment. They also help in explaining policy choices to the public, making the entire process more transparent. By carefully analyzing future growth prospects, central banks aim to keep the economy stable and promote sustainable development.